to today's report, the 29th of March 2023. So just to let you all know, today is also the last day of the trading for March, right? And usually this time, if you have already profited, it's actually a good time to actually stop trading, to be frank. One of the reasons because is that there are a lot of profit taking happening, and sometimes price do not move as per expectation due to whatever reasons behind. Sometimes there are some certain fund managers, they want to close the trades for the month to book whatever profits they have are closed and do so they can do the calculations. So sometimes the levels given to you, they react by very short while, or sometimes they don't react at all, or they react probably next week. Okay, so this kind of things can happen during the last trading day of the month. In fact, the last trading week also sometimes like that. It happens on Thursday and Friday. But to let you all know also one thing, today is I don't expect much movements in fact, because of the Easter holidays, and you have the entire market on basically starting from the morning session, like New Zealand, Australia, the Oceania market, they're having holiday, the banks are closed. And then the European market, the same thing as well. In Germany, in the UK, and then in the later in the evening, that's the Canadian market is also closed. The only market that's open would be the US market. So if there's any news that's going to move anything, that would be the core PCE price index tonight. Okay, so that is also an important data for us to understand, what's going to happen next to the market, because we are moving into times where the datas that's coming out, economic datas that are coming out. It's very crucial and can add some movements to the stock market as well as the currency. So that comes to the topic on discuss today. That is the topic and discuss today is the rising bond yields and its possible effects. Okay. So during last week's Federal Open Market Committee meeting, in short, the FOMC, the Federal Reserve maintained its projections of 3 rate hikes for the current year. That we know about it and we discussed. Now, this stance suggests that if the Fed considers reducing rates, it would indicate confidence that inflation is under control and on a downwards path, right? So if they want to reduce, that means everything is okay. Despite this expectation, borrowing costs have continued to escalate. A recent report by the Wall Street Journal highlighted that as of Tuesday, the yield on the benchmark 10-year US Treasury note had risen to 4.233, an increase from 3.86 at the end of last year. So why is this rising? Now, the inflation data for January and February came in stronger than anticipated, further fueling the upward trend in interest rates. Now, consequently, the average rate on a 30-year fixed mortgage and the cost of borrowing in the corporate bond market have both seen an uptick so far. The rise here has caught many on Wall Street off guard, as the consensus was for yield to decline, and it has exasperated Americans who have been hoping for a relief from mortgages rates that are at their highest in 2 decades. So the Federal Reserve Governor, one of the governors, Christopher Waller, has stated that there is no immediate need to reduce interest rates. He labeled the recent inflation figures as disappointing and expressed the need for at least a couple of months of better inflation data before considering rate cuts. Waller cited that strong economy and solid job growth as additional factors, allowing the Fed to wait for more evidence that inflation is consistently moving towards the 2%. So here is already a clear hint. What they want to tell you is that what they want to look at, this jobs data, number one. Okay, So how do we know the economy is strong? You look at the GDP, that's one. And the next thing is that, of course, the inflation data, these are telling you, because this one is a question mark again. So next week, right, we will have the non-farm payroll once again. We want to see all these revisions. You know, they keep on doing revision, 100,000 revisions. This is not something, people can just readily accept it. Say there must be something wrong. How can you revise to the point of 100 over 1,000, right? So that's why the validity is being questioned right now. So as such, right, the question then arises, what will happen if inflation remains stubborn? Okay, remains stubbornly high in the coming months. How do you want to deal with that? So what the expectation right now is that, and the investors are currently anticipating rate cuts by June, hoping such measure would encourage borrowing and investments. However, any delay in implementing these cuts would provoke a market sell-off as initial expectations are thwarted. So if we have inflation data keep on going higher and higher, this kind of stuff happening, then you can see that it can provoke a market sell-off. So going forward, if we have more solid data, okay, more and more solid data, especially as we approach June, you have to be careful, because if you see, the market has been on in an uptrend. The S&P 500 has been uptrend, Nasdaq the same thing, everything all in the uptrend. So there would be a catalyst eventually that causes the market to start correct. So these are the catalysts. So it could be cases where good news equals to bad news, whereby because of so many good news, right, the Fed says, okay, they're going to cancel the outlook of increasing interest rates 3 times to 2 times or even to 1 time on this sort, or say they're going to delay it, like what Waller mentioned. This kind of things can actually be the catalyst of that market correction. Okay, so this scenario could necessitate a recalibration of future interest rates expectations, affecting various sectors differently depending on the sensitivity to interest rates. So what the sectors that are sensitive to interest rates, the real estate sector, and then you have the banking sector, and then sometimes the tech sector also as well in situations like this. So all this can actually bring the market down, right? So should inflation persist at high levels, it might introduce heightened uncertainty and volatility into the stock market. Investors' concerns over the Fed capacity to manage inflation without hampering economic growth could lead to more pronounced market fluctuations as reactions to inflation reports and Federal Reserve announcements become increasingly jittery. Okay, so that's the update for today.